Assalamualaikum warahmatullahi wabarakatuh. Introduce myself. My name is Putri Veronica. I'm from Manajemen 22A. My NPM is 224114040. Market risk management. Market risk is the risk of loss occurring on financial investment due to unfavorable price movement. These risks arises from movement in stock price, interest rates, exchange rates, and commodity price. Referring to corporate financial institute, market risk is not specifically related to the company or industry in which someone invests. However, this risk depends on the overall market performance. Therefore, it is important for investors to monitor various macro variables related to financial markets, such as inflation, interest rates, balance of payment situation, fiscal deficit, geopolitical factors, and others. Of market risks. 1. Interest rate risks. Interest rate risks arises from unanticipated fluctuation in interest rates due to monetary policy taken by the central bank, causing a decline in security price. 2. Commodity risks. Any volatility in the particular commodity, such as oil or grains, can affect the performance of the entire market and often lead to supply-side crisis. Such shocks result in declining not only in stock prices and performance-based dividends, but also reduce the company's ability to pay its principal amount. 3. Currency risks. Currency risks are also known as exchange rate risks is a risk that refers to the possibility of a decrease in the value of returns obtained by the investor due to the depreciation or reduction in the value of the domestic currency. To reduce the risk of losing foreign investment, developing countries maintain high foreign exchange reserves to ensure that any possible depreciations can be offset by selling these foreign exchange reserves. For country risks, various macro variables that are outside the control of financial market can influence investment returns. For example, the level of political stability, level of fiscal deficit, vulnerability to natural disaster, regulatory environment, ease of doing business, and others. For this reason, the level of risks associated with this factor must be considered when making international investment decisions. How to manage market risks. 1. Determine the company's risk tolerance. Before developing a market strategy, a company must first determine how much risk it can bear. 2. Asset diversification. A simple strategy to manage risks is to avoid all investment in the same risk sector. Diversifying asset classes can ensure that losses in one area are offset by stability or against another. 3. Investment hedging. This is an investment strategy to minimize potential loss that may be experienced if the value of shares falls. This is done by purchasing options which give the company the right to sell shares at an agreed price if their value begins to fall. 4. Stay informed, be aware of market change and how they can affect investment by following stock market developments and movements. 4. Don't rush. If the value of the company share falls, don't panic. Small changes in the market may only have a temporary impact. Before selling, observe overall market trends and determine whether the company is able to sustain. I think enough. Thanks for your attention and see you. Wassalamualaikum warahmatullahi wabarakatuh.